So it's definitely not uncommon knowledge that the stock market does climb higher over a long duration of time, right? Basically many, many years and decades. And of course, that's the whole reason why many people invest in the stock market to begin with. So naturally, of course, whenever a bear market rolls around, like we're now experiencing in 2022, it makes sense for a lot of long-term investors to buy into many stocks or index funds, ETFs, etc. at very discounted prices, and therefore they can hold those assets for the long term and hopefully make a very nice return. Now that being said though, trying to do so with leveraged ETFs, right? Basically trying to buy into these kinds of products as the market is going down and hoping to make a leverage return once the market does recover. This is actually very, very risky. And in fact, once the market does actually recover, you are still likely going to be down money by a huge, huge amount. And so for this video here, we're going to explore the danger of leveraged ETFs during bear market environments, both through some mathematical examples as well as some historical examples based on the last real bear market we saw in 2008. Now briefly though, before we get started here, make sure you guys watch until the end of the video because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks and each stock could be worth up to $2,500. And also, if any of you have an interest in joining a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. And I do have a separate video that will give you guys a great overview of that Discord and discuss all the main features and benefits that you'll receive once you do join. So I'll post a link to that video as well as a link to my sign up page in the description of this video below. And once you do join, you'll get a 7-day free trial. And lastly, for anybody who is brand new to the channel, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright, so first off guys, just briefly here, what exactly are leveraged ETFs in case any of you are not aware? Well, essentially, these are just ETFs, but they will give you a multiple of the return of a regular ETF. So for example, a very common regular ETF for the S&P 500 is SPY. And then the 2 times leveraged ETF of SPY is SSO. And basically the way this works is SSO will double the daily return of SPY. So for example, if SPY goes up by 1% on any given day, then SSO is supposed to go up by 2%. And then conversely, if SPY goes down by 2%, then SSO will go down by 4%. It just doubles it. So naturally, you might think that if SPY has a positive return on any given year, then SSO must have a return of 2 times that amount. Well, as you're going to see in this video, that's not necessarily the case. And in fact, as you're going to see here in a moment, because leveraged ETFs do have much greater volatility in their price swings because, of course, they're trying to magnify the returns of regular ETFs, this, mathematically speaking, is going to have the potential to kill your returns in certain market environments. So ultimately, if SPY, for example, is up by 10% in a given year, that does not mean SSO will be up by 20%. In fact, it could still be down for the year. And so now at this point, let's take a look at 2 different mathematical examples that will illustrate my point here. So basically, we're going to compare 2 different investments, investment A and investment B. And investment A will behave much like a regular ETF, and investment B will behave much more like a leveraged ETF. And so the way this hypothetical example is going to work is we're going to analyze these 2 investments over the course of 1 full year, 12 months. And during that year, 6 of those months are going to each have a positive return. And as you'll see here, it does not matter when these months actually occur during the year. They could be the first 6 months of the year, or they could be completely randomized. But still, 6 total months will have a positive return, and then the other 6 months will have a negative return. And then we're also going to calculate the average monthly return between both investments, as well as the 12-month compounded return. Basically, what your return would be if you put money into each one of these investments, and then took your money out after 1 full year. So first looking at investment A, we're going to say that 6 out of the 12 months for the year are going to each have a positive return of 3%. And then the other 6 months are each going to have a negative return of negative 1%. So now we'll figure out what the average monthly return is for investment A. And here is the formula to figure that out. And once you run the numbers, you get an answer of positive 1%. So there we go. Even though during half the year you are losing money, the average monthly return is still a positive number. That's good. Now, before we figure out the 12-month compounded return for investment A, let's first look at investment B, which again is going to behave much more like a leveraged ETF. So in this case, we're going to say that 6 months of the year each had a positive return of 20%. Very, very large. And then for the other 6 months, each of those months are going to have a negative return of negative 18%. And so now, what is the average monthly return for investment B? Well, here's the formula to figure that out, and once you run the numbers, you will see that it's also positive 1%, the exact same average monthly return as investment A. Very cool. So perhaps now you might be thinking that both investment A and investment B, because they have a positive average monthly return, must also give you a positive 1-year return as well. Well, now we're going to find out. So in regards to the 12-month compounded return for investment A, here is the formula, and once you run the numbers, you get a positive return of 12.4%. So again, this would be your return if you put money into investment A, and then you took your money out after a full year. You would make 12.4%. Pretty good. But now what about investment B? Well, one last time, here is the formula, but once you run the numbers here, you actually get a negative 9.2% return for the year. So even though both investments A and B have, in absolute terms, a greater positive return, specifically for their winning months, right? 3% is greater than 1% and 20% is greater than 18%. And also both investments have the exact same positive average monthly return of 1%. But obviously, as you can see here, at the end of one full year, one investment actually makes money, the other investment loses money. So there we go. Those are two mathematical examples that hopefully very clearly illustrate the issue of increased amounts of volatility in regards to leveraged ETFs. And so for bear markets in particular, one of their defining characteristics is drastically increased amounts of volatility in both directions. And that specifically, right, the bidirectional volatility in a bear market is what kills returns for leveraged ETFs. And so now at this point, we're going to jump over to my computer here and we're going to analyze the last real bear market that we saw, which was back in 2008. And we're going to compare how SPY did during that time with SSO. And you're going to see just how large the discrepancy was between these two ETFs once the market finally did recover. So let's dive in and take a look. All right, guys, so now what I'm showing you here in thinkorswim is two charts, obviously. And the one up top is a chart of SPY, which again is the regular ETF for the S&P 500, and specifically during the entire bear market that we saw back in 2008. And then on the bottom graph here is the exact same kind of chart, a weekly chart, but of SSO, which is the 2 times leveraged ETF of the S&P 500. And again, same thing here in terms of the time frame. This is also showing you SSO during the 2008 bear market. And so for the sake of our comparison here, we're just going to assume that this bear market began at the very beginning of 2008. So basically this line right here, even though it says 2007, this line just marks the end of 2007. So everything to the right of that line is 2008. And same thing on the SSO chart down here. As you can see, both of these lines are lined up at the beginning of 2008. So now looking at SPY first here, and as we can see right around there, at the beginning of this bear market, SPY was around a price of about $140 per share or so. And then of course, once the bear market really got going, over the course of about one full year, SPY came down all the way to around $70 per share. So that's a decline of about 50%. And then obviously, as you can see here, kind of at the beginning of 2009, the market finally bottomed and began the new bull market. And so ultimately, it wasn't until the very beginning of 2012 where SPY once again attained a price of $140 per share. And just to get a bit more specific here, we'll say that right around mid-March of 2012 is when the S&P 500 finally recovered all of its losses. Now, what about SSO though? Well, again, our starting point is right here at the very beginning of 2008, and SSO opened the year at a price of around $9 and call it $75 per share or so, $9.75. And so keeping in mind that the S&P 500 or SPY fully recovered by around March of 2012, so pretty much right at this point here, well, obviously, as you can see here, SSO was still down by a very, very large amount. So in particular, during that time, SSO was still down at a price of around $7.45 or so. Which, if we compare this price to the starting price at the beginning of 2008, right, This means when the S&P 500 finally recovered all of its losses, SSO was still down by about 24% or so. And in fact, it wasn't until right around, let's say, May of 2013 where SSO finally recovered all of its losses. So basically here, it took more than one additional year for SSO to recover. That's a very long time. And again, this is all because, as I showed you with those mathematical examples, because during bear markets, you see a lot of bidirectional volatility, right? Even when the market is trending downwards, you will still see some very large bear market rallies that could last for multiple weeks, and then subsequently some very, very large and prolonged sell-offs, especially in this zone right here. So bottom line here is obviously, as you can see, buying into leveraged ETFs during bear market environments is extremely risky, and chances are even when the market does actually recover, you will still be down a lot of money on your investment. Now that being said though, the one major caveat with this is if you do still want to invest in leveraged ETFs during this current bear market of 2022 for the very long term, meaning many, many decades, then perhaps that could be a decent idea. And the reason for that is, again, over very, very long durations of time, the market does tend to climb higher, even with bear markets and large crashes happening in between. So over the very, very long term, leveraged ETFs can outperform the regular ETFs like SPY here. So basically here, if we zoom back out on both of these charts and get a very, very macro view, again, here on SPY was the bottom of the 2008 bear market. And ever since then, we've seen a one-directional bull market. And this here is the exact kind of environment, a one-directional bull market, where leveraged ETFs perform the best. So again, here on SSO, this was the bottom of the 2008 bear market, and this ETF had a price of only $1.77. But now fast forwarding to today, even with this current bear market going on, SSO now has a price of $47.62 per share. So obviously, if you do the math here, the percentage gains on SSO during this entire time, right, basically over 14 years, the percentage gain is much larger than for SPY here during the exact same time frame. So once more, over very, very long time frames, many, many years and decades, then sure, buying into leveraged ETFs like SSO could be a pretty decent idea. But ultimately, just be aware that during bear markets, it is going to take a lot longer for leveraged ETFs to recover than the regular ETFs. And so with that being said, that's going to do it for this video. But one last thing, as I mentioned, I do have a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord as well as my SKILLSHARE courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.